GM. Today is Sunday. It's the 10th of June. Let's look at daily levels. So, I've mentioned the potential for BTC to be bearish here. And one of the things I talked about in a previous stream was this. It was BTC following the black path, where it moves up to the highs, fails to break out, comes back inside. So that's exactly what happened with the Friday move. Since then, sitting sideways, consolidating over the weekend at exactly the 2021 all-time high. Below us, we've got a weekly open from Monday this week, and we've got the monthly open, which is below. So the lower line is the monthly open, the upper line is the weekly open. So that's the dividing line between a green week and a green month for BTC. Currently in a green week and a green month so far. Until you see a flip of the blue zone or the red zone, there isn't really a strong directional bias on BTC. I lean bearish short term, but if you remember earlier in the week, one of the things I talked about was a shakeout happening and that dips would be for buying. So originally, early in the week, I was looking at dips into 69 or 67 being good buying opportunities. And so what would separate the buying opportunity from a further bearish move? I think some of the things that are holding me back are the ETF flows are being misinterpreted by people, right? So these ETF flows are very much the same as they were in March. When you look at the $1 billion inflow day that happened on the 12th of March, a lot of that was simply arbitrage. So Bitcoin's funding rate got so high that people were buying the ETF and then shorting either the CME futures or, if they're able to, short one of the perpetual futures on a centralized exchange. That's it. Simple as. So it's not directional money. And what happened then is that we exhausted all available buyers, all available demand. Price couldn't go higher, and then it dropped back. And then we saw outflows of roughly the same amount. So we saw, over the space of a few days, we saw 320, 150, that's about 450, 5, 6, about 600, 700. About 700 million flowed out in the space of 5 days following that. And what it was GBTC really ramping up their selling and the rest just disappearing. So if there is such underlying demand for the ETFs from directional buyers, why did it dry up so much in the following week, the very next week? Price wasn't down that much by that point, right? This was over here. We'd had an initial sell-off and we were bouncing. We were still above 65 and then we dipped down as low as 61, but then within a week we were back up at 72. Right? By the time we got to 26th of March, we're back at 72. But the flows never really recovered. We got one high day, 418, and then that was it. You notice consistently 418 was over here. You notice consistently that the highest flows come at peaks. And that is also, in my opinion, because of funding rate. I think it's very simple. When you look at that peak on the 26th, 27th of March as well, that second bounce, we still had positive and rising funding. So I think a lot of the ETF volume is being driven by hedge funds playing a basis trade. They're just arbing. They're collecting free money, right? Relatively free. You do take some counterparty risk. So what does that actually mean going forward? I think the market will adjust to this, but it hasn't yet. I still see people talking about how many billions are flowing in and assuming that that's all long-term money, and it's not. Why does that matter? It's the exact same as what happened in March. No matter why those 2 billion in 3 days, right? The 600 million, 500 million, 1 billion that happened over here. Doesn't matter why they happened, right? Let's forget about that for a moment. What matters is the market took that to believe, oh my God, there's literally billions of dollars flowing into ETFs that is slow money. They're not going to sell. This is what we've been waiting for. There's only 30 million of BTC mining rewards emitted per day, and we're getting hundreds of millions of these one-way flows. But they're not one-way. So, when the ETF flows are high, people like you and me will buy it. We'll buy Bitcoin, we'll go long, right? Retail. By the way, everyone you see on Twitter, everyone you see on YouTube, everyone you talk to, all retail. This whole thing about when's retail coming back, everyone is retail. Crypto went from 5% exposure in the world to about 40% between 2017 and 2021. So across one cycle. It would have went probably from 5 to 15, except COVID happened, locked everyone in their house, and everyone became a shitcoin flipper. That explosion, COVID, has actually just turned crypto into a retail market. That's what it is. Think about it. If all we're talking about is how the regulations are so bad, so bad that people on Wall Street can only buy Bitcoin in a regulated way. They can't even buy Ethereum yet. They will when the ETFs go live, but they can't yet. What does that tell you? If Wall Street can't buy it, if Wall Street can't buy Cardano, or Avalanche, or Solana, or Doge, or Pepe, who the fuck's buying it? It's fucking retail. It's all of us. We're all retail, right? Now, it's all about how you think. Dumb money and smart money is a much better characterization than retail and not retail. But when you see people on Twitter talking about retail aren't here, they are fucking retail. It's like, what are you talking about? You came in 2020 and flipped shitcoins during COVID, and then you went away and you've got a relatively small portfolio, and you're back and you're buying meme coins and you're wanting to go. That's retail activity. You're not professional. You don't have an office. You don't have a team. You don't have investors. Right? So, when you see all this, understand what's happening. The ETF flows come in and they're high. Retail goes long Bitcoin with leverage because Bitcoin's too big for them to buy spot. Think of the average participant who doesn't have much money or really a whole lot of knowledge. We're talking apes here, not talking smart money. Like many of you trade in very systematic, smart ways. I consider you to be smart money because you're disciplined, you manage risk, you position size correctly. But on average, crypto people just get long on leverage, trying to catch the God candle breakout so they can escape their miserable existence and get rich from magic internet money. That is the mindset. Hyper gambling. And so when the ETF flows are high, people reflexively buy and get long. But when they don't understand that the ETF flows are not driven purely by bullish buying, a lot of it is just arbitrage, then when those ETF inflows don't equal price going higher, like we had on Friday, it actually equals price going lower, and you're trading below those levels, and then you see the outflows, which are real, you have an absence of buying pressure because retail already got max long at the top. You now have genuine outflow pressure from the ETF arbitrageurs who are closing them. And the reason why they'll close them is because funding rates normalize, which they have. So the basis trade right now is no longer profitable. If you look at the funding rate and you put it into annualized, it's 9%. It's not really a great risk reward to buy Bitcoin, short the futures to get 9% return right now. And on the CME, although it's closed at the moment, we can see what that basis would be. TradFi, CME annualized basis, here we are. Let's zoom it into 1 month view. It's currently at 11.79%. That will drop further next week. I think once it's below 10%, there's not a huge amount of reason for these big funds to be long spot short Bitcoin. So what they'll do is they'll probably redeem, they'll sell the Bitcoin ETF shares, and they'll close their shorts. But closing the shorts won't equal a short squeeze, of course, because at the same time you've got an equal amount of sell pressure from spot. So we've had this now several times. We had that peak over here, and eventually in the unwinding, price went down. So I'll leave this almost as just a mini lesson. Like, if a basis trade is long, spot, short, futures, when you close, it should be neutral. Okay? If you are long spot, you buy a Bitcoin, you short futures, you short one contract of Bitcoin, your buying and selling should cancel each other out, and it should not affect price, right? That's why if you see someone, you're like, oh my God, someone's just bought 1,000 Bitcoin on Coinbase. Okay. But what if they've shorted 1,000 contracts on futures and they're delta neutral, they're hedged? You don't know that. But there is a different dynamic in the crypto market where the spot market is less liquid than the futures market. The spot market, because there's no leverage, the spot market is maybe 10 times smaller than the perpetual markets. And so in theory, if you were to buy a lot on spot, it would cause more of an impact on the spot market than your hedge would on the futures market. And that's how price can actually rise higher, even with the basis trades. Okay? That's one example of how it can affect. But we're talking about the opposite side here. We're talking about what happens when you're closing it. The same thing applies in reverse. What happens when a big hedge fund wants to close their basis trade, so they want to sell their spot or sell their ETFs, and they want to close their futures trade? Well, the futures trade will be easier to close, much more liquid. But, especially depending on the low time frame price action, if you're then trying to close a large spot position into relatively thin books, not much liquidity, you can cause more downside. But let's just imagine, all else being equal, it's neutral. Hypothetically, right? You buy one Bitcoin, you short one Bitcoin, you then sell that Bitcoin and you close the Bitcoin short, nothing happens, okay? So why would price actually be more at risk of going down when these hedges and these basis trades finish over here? Why have we gone down? Why could we go down more based on that? Because retail mistake, or let's call them dumb money, because retail can be very smart. Dumb money mistake, ETF flows for bullish buying. And dumb money mistake, ETF outflows for bearish selling. Now, I don't know how long this will go on for, but I am very confident that the average participant is still not aware that this is a thing, and they are not smart enough yet to understand it. Just like people didn't understand funding rate in 2021, right? You know exactly what funding rate is. You're well aware of it. But in 2020 and 2021, the average participant did not understand what funding rate was. That's why when you put on a funding rate chart and you zoom out and you go back, you look at this. Even in our most peak euphoria here, that was as high as funding rate got during the massive Bitcoin ETF hype. In 2020 and 2021, we spent months and months and months at those levels. People, the average participant, did not understand the funding rate mechanism well. Then they learned, and they learned the hard way by getting destroyed when prices crashed. And so they understand, oh, when funding rate gets high, be careful. So people, generally, as a whole, get smarter. They should. This will also happen with ETFs. But currently, I still see this, it's all over Twitter. If you have a big day of flows, people are saying, wow, super bullish, loads of flows. And then when we have the outflows, remember a few weeks ago when everyone was panicking and crying at 57k Bitcoin? Oh my God, the outflows are terrible, it's billions of dollars, everyone's fucking selling, the ETFs are dumping on you, you're fucking wrecked. So why does it have a greater impact than it should when these simple basis trades close? Because when the basis trades are opening with the high ETF flows, retail mistake that, dumb money retail mistake that for bullish buying and they get long. And then, when inevitably these hedge funds close the basis trade, which is just simply outflows from ETFs, the same dumb money retail mistake that for bearish selling and they panic and sell or they get liquidated. So it's a perfect setup For the smart money, when price goes up and funding rate is high, okay? Let me draw one more fucking thing. This is just going to end up being a full mini lesson. So when price goes up and funding rate goes up, price up, funding up, okay? Equals price up, funding up, basis trade. Right? Price up, funding up equals basis trade opportunity. That's what the hedge funds see. That's what they understand and realize. Price goes up, retail wants to buy, dumb money wants to buy, smart money wants to buy, everyone wants to buy. Bitcoin going up, who doesn't want to get on that? It brings funding rate up, which then creates an opportunity for a basis trade. But what's even better, at least at the moment for them, is they also know that when price goes down and funding rate goes down, and they close out that very simple basis trade, it will create panic and liquidations, and it will wreck retail, dumb money, and they can just get back in and ride it all again. Equals bullish buying opportunity. So think about that. They basically win in both ways. If you're a hedge fund or an institution and you know about crypto, the only thing to do is be looking to get long. So what they'll do is, when funding rates are low and price is down, it's a buying opportunity directionally in a bull market like we're in. Directionally, not about the basis trade. Because when price then goes up and funding goes up, they can hedge it out. So let's go back to the chart and imagine this happening in real time. I'll go to the chart actually that has funding rate on it. Okay? When price is down and funding rate is low, the odds are in your favor to get long. So they get long. Okay? Then price goes up and funding rate goes up. And what can they do then? Because they're long from down here, they can hedge it for free and make even more free money. So by shorting, they lock in the price. So if they bought at 40 and they short at 52, or they short at 60, or they short at 65 or 68, they're also locking in their gains and getting paid funding. It's like a double whammy. There is also another type then who comes in who doesn't buy down here at all. They just wait until funding is high and they buy one Bitcoin, short one contract of Bitcoin. That's the one I talked about before, basis trade, delta neutral. They just collect the free funding. So can you see why Wall Street love Bitcoin so much? And eventually they'll love all of crypto. There's an infinite supply of dumb money retail who always want to buy and push funding rates higher so they can capture free basis. And it's always a good bet to buy Bitcoin when funding rates are low and the market is in fear. Because as soon as it returns, as it always does, back to some kind of optimism, they can close a trade in profit or play a free basis trade. And retail don't play these trades because they don't have enough money. They don't like, oh, what? I want to lock in 25% annualized on my Bitcoin. They're never going to do it. They just can't even think in terms of an annualized rate. So this is still an opportunity that's open to them and free to them, and always will be. The average retail will never have enough money to do it. So that's what's going on behind the scenes. By the way, this is not the only thing that's happening. I don't know exactly what moves the market at all moments, but that's one thing. And I think as that trade unwinds here, I think there's potential for us to go lower. What would make me bullish is if we don't go lower for a few more days. If we move up on Monday, back down on Tuesday, and we're still holding 69, going into CPI on Wednesday, I'll be bullish. I'll be very bullish. Because this should have follow through relatively soon. And I am still expecting follow through. And I'm aware of it. Right? This current move at the moment has had no move, like no bounce worth speaking of. So let's just see how it reacts. I did talk yesterday about price going higher and taking out the highs. That's potential too. But I'll break that down a bit more in trade of the day. So, GM.